Yep, it's recording now.
Great, thank you. So tonight we got Chris Hampton presenting SPACs in general and HAACU specifically. We'll go through our trade of the week, trade of the month updates, which are looking really good, by the way. I got a peek at those numbers. Good job, guys, on those picks so far. And we'll go through some housekeeping notes. Disclaimer, just want to remind everyone, Story Trading is not an investment advisor. I am not an investment advisor. Investing in securities involves significant risk of loss. We are recording this presentation for private distribution to our paid subscribers. Okay, you all know what story trading is about, so we don't need to go through that. And we're going to go through some stats. So this is a pretty big jump. I think it was like 37%, but our average return now on our featured presentation stocks are 49%, and that's from the date they were posted. You know, if you normalize that for like an annual yield, it's going to be much higher. But wow, Adam, right at the top now from Dan Carlson, lots of 100% returns or close to 100% returns. So awesome.
Yeah, Adam was presented just a few weeks ago.
Oh my God.
2 weeks ago. It's about 180.
December 6th. Good evening, Rob. December 6th, 170%. Freaking amazing. Okay. Awesome. And Dan Carlson's probably going to rejoin our community, by the way. I don't know if he's here tonight.
And just to mention, we recently took off INTZ up 175%.
Oh, all right. Yeah,
that position was closed, and even some of the positions that weren't doing as good, like PBI was down 30%. Now it's back to -9%, and even some of the positions we dropped previously are up to doing better.
So yeah, those ones that we closed, like INTZ, we should probably track that somewhere here as well. But amazing. All right, good job, guys. So with that, we're going to turn it over to Chris Hampton. If someone can give him screen share permissions, and I'll just throw up a chart. Oh no, let him talk about specs first. Chris, you there? Oh, I forgot to put my pretty background on tonight. How come no one told me? Choose virtual background.
You might have to ask to unmute. I don't have the ability for some reason, but.
Oh, you don't?
No.
Where
there
is
we
Chris?
go.
Oh, Chris is good. Okay.
You can hear me?
Yeah.
All right, good. Can you make my desktop?
You should have share screen ability right now.
Yep. All right. Ooh, that makes it complicated. Okay. All right, here we go. SPACs, special purpose acquisition companies. They are public traded investment.
Hey, Chris, do you mind hitting the that little presentation button on the bottom right so we can go full screen? That little icon, it's on the bottom right to the left of the minus symbol. You have that slider minus plus, and there's the first icon to the left of that minus plus. Yeah.
In the
right on the bottom right, you see that slider where it says minus plus 86%.
Yes.
Okay, that first icon to the left. Is that
slideshow?
Yeah, slideshow. That's gonna go full screen. Yep. Cool.
Brilliant.
Thank you.
And I learned something too. All right, special purpose acquisition companies. They're publicly traded investment where a management team raises capital in an IPO for the purpose of making an acquisition. They're also called a blank check company. Waiter, which many of us know was brought public this way. After the IPO, the SPACs typically give management around 18 to 24 months to either complete an acquisition or return all the capital to the shareholders. So the proceeds from the IPO are kept in a segregated trust account. Investors can choose to redeem their shares for their share of that trust account if they don't wish to participate in the acquisition. And so this trust forms a floor for the SPAC, at least until the merger's closed. So many people, have pointed out the scamminess in the SPAC world, but at the same time, there's been an explosion in both founder and investor interest in SPACs. Like a lot of the investing world, there are a lot of problems with SPACs, but there are also a lot of opportunities. They're alternative funding schemes that allow early investors and employees access to more capital with which they can grow their business, or they can use that capital to cash out. For the founders, it can offer them, for the founders of the SPAC, they can get just fantastic levels of compensation simply for finding the target and merging. And investors can make fantastic returns. Through this process, there's a strong incentive for the founders to get a deal done. If they don't make a deal for some kind of combination, they don't make any money. The funds from the IPO are returned to the investors, and they can be on the hook for founder shares that they paid a nominal sum for, as well as warrants that they typically buy, founders warrants. So people that have been involved in private equity at all probably know that over the last 10 years, private equity has gotten very crowded, and in a lot of ways, public equity has become the new private equity. And investors at the same time have changed as well. They aren't so focused on quarterly earnings, and they're willing to invest in early stage companies. Maybe because there's been so much press on the success of venture capital and private equity. But the SPAC boom is at least in part public equity taking on the role of what private equity used to do, opening up to more participants, not just the well-connected and already wealthy. And the view of a lot of companies and SPAC founders is that on balance, the public market will give companies and the sponsors a better valuation than private capital will. So like Larry Fink said, the CEO of BlackRock, he thinks SPACs could replace private equity platforms. So the way owning a SPAC actually works, you can get in pre-IPO. I'm not sure how you can do that. TD Ameritrade won't let me do it, but you can buy in immediately after the IPO. And for usually about 52 days after the IPO, as soon as they're listed, they trade as units with a U appended to their ticker. The units are one share of common and some combination of warrants or other derivatives. Typically, it's some portion of a warrant, usually between one whole warrant and 1/5. A good rule of thumb is that the higher quality the SPAC is, the fewer warrants you'll get, or the smaller portion per unit you'll get. So the units start trading immediately, and the companies file Form 8Ks from that point on. And after 52 days, the units are available to split. As the owner of the unit, you're responsible for actually calling your broker and splitting the units into common shares and warrants. And when you do this, this is a problem, but it's something you just have to deal with. Your shares will be locked up for a week, maybe as much as 2, as that transition is made. Apparently the warehouses are kind of busy and it's taking longer than usual these days. So if you buy the units and you want to split them, there will be a week or two where they'll just sit in your account. You can't move them. You can't trade them. So if you buy a SPAC at the IPO at $10, it's theoretically riskless. All you're really risking before the deal is finalized, assuming there's no big fraud, is time and opportunity cost. Let's see. So there's SPACs have exploded. There's a huge amount of money in SPACs, and they're all chasing deals. And every single one of those SPACs, their founders are aware that if they don't get a deal done, they're not going to make any money. So there's a lot of pressure to get a deal done and a lot of competition. So the market is drawing a huge amount of investor interest and a huge amount of SPACs. And the end point of the funnel, the companies actually have to make acquisition. That's where I think a real squeeze is going to start happening. And it's going to be more and more important to look for SPACs with both great management and very good structure, and to avoid SPACs with certain characteristics. The first, a lot of SPACs are foreign, a lot of times the Cayman Islands. Whatever you think about a company incorporating the Cayman Islands, there are also just taxation problems. Passive foreign investment companies, which because a SPAC does have that trust fund, it qualifies as that. And if you buy more than $25,000 worth or hold for more than a year, you're going to end up being penalized tax-wise. But if you're interested in buying one of them, check with your accountant. So other things to avoid with SPACs. You just have to read the prospectus in S1s. If you see the founders are drawing salaries pre-combination, that's a big warning sign. If you see Shaquille O'Neal or Jay-Z is one of the founders, that's another warning sign. There's just a lot of crap out there. You want to find the good management teams. Warrants are just a big mess. If you want to buy warrants, you're going to have to get through the warrant agreement, and it's going to be thick language. But generally for all these SPACs, buying warrants above 4 isn't worth it. They start to lose their leverage around there, completely losing it around $6.50 and advancing percentage-wise in tandem with the common. If you're interested in buying warrants individually, try to get them under 2 and preferably under $1, perhaps as a lottery ticket on, a mediocre SPAC. If you want to hold these through combination, check the lockup periods. If any of you noticed what happened with QuantumScape last week, it dropped 44% because a lockup period expired. There can be a race for the exits. But the biggest problem with SPACs, and the thing that people are most critical of, are the huge promotes or founders fees. The founders of these, the guys that manage the SPACs, they typically take 20% of the shares. And you'll see this in all the kind of scammy, exploitative SPACs. They're all at 20% promotes founders fees. But there are more and more SPACs that aren't doing that way, especially at the higher end of the market. The highest profile is Bill Ackman's Pershing Square SPAC, which did a tontine structure, which if initial investors try to trade their shares or sell out before the combination, they lose their warrants, and those warrants accrue to the people that stay in. Other high quality SPACs like Ajax, that only had a 10% promote. LUXA, which is in the telehealth space and isn't a bad SPAC, has a forward purchase agreement where the owners of the SPACs, when it comes to do the combination, rather than gaining extra money by putting out a pipe, they'll actually cover the additional investment themselves. But clear standouts, PSDH, Bill Ackman's is one, but the one I want to talk about tonight is HAAC, Health Assurance Acquisition Corp. It's founded by a bunch of guys from Livongo, both the executive chairman and president of Livongo, as well as someone from the former chair of the Federal Reserve Bank of San Francisco, the CTO of Dropbox. It's good. This is a top tier management team, and they're in the telehealth space. What makes them very high quality is that they're not taking the 20% promote. They're taking 5% in something they called shareholder aligned shares. They coined that term. And it structures their payout almost like a hedge fund. They don't make anything unless the share price appreciates. And they gain between 20 to 30% of that appreciation yearly as it goes up. It's similar to what a hedge fund manager would make minus the flat fee. In order for them to get something equivalent to what a typical SPAC manager would get, the price of the shares have to get to $20, which it very well might. And the net asset value is $10. The units are still trading. You can get them now for about $11.50, and I think they're a great buy for $11.50 or under. There's only 1/4 of a warrant attached to each, but if it trades like other high quality SPACs like Ajax, whose units split earlier, those warrants will trade up to $4 pretty quickly. You can kick them out and knock $1 off of your cost basis. Also, I'm going to put their overview and mission statement online. It's probably about the most galvanizing piece of text in an S1 I've ever encountered. And these SPACs, it's salesmanship. Like venture capitalists, they're creating something from nothing. They're going out there and getting a deal done. And I don't know, that mission statement is part of the reason why I'm pretty heavily into this one. A second one I'll highlight, which I won't say is high quality, but it's interesting and provides an opportunity, is Zanite. They're targeting the aerospace industry, which will probably have a lot of opportunity in it and fantastic management. They do however, take the full promote. What makes this one really interesting, 2 points. They've got a net asset value of $10.10, just a little higher than normal. But as recently as Wednesday, their units were trading for $10.40, and their units had half a warrant attached, which is just a fantastic arbitration opportunity if you can get it at $10.50 again. Also interesting is that the SPAC has given itself a timeline of only 6 months to make an acquisition. So there's a high likelihood they'll put out a letter of intent or announce an acquisition in the next 4 months. They do have options to extend that, but for 6 months period, but each time they do that, they have to kick in an extra couple million in warrants, which raise the net asset value another 10 cents. Let's see. Another thing to look out for, did I mention, oops. Yeah, that they're drawing salaries. Yeah, that's actually it. I hope that information wasn't too dense. Mostly I want to convey there's a continuing opportunity in this space, but it takes just reviewing the S1s. This is, if more people join and get active in the SPAC research group, and pick an S1 to go through and tell us what you saw, we'll all find more opportunities. Because there's a dozen SPACs a week coming out these days. All right, that's it.
Great. Thank you, Chris, so much. I dropped the SPAC research group link into the VIP investing group for those of you who are not aware that we did have a SPAC research group. We also have a SPAC trading group. We divide them up so we could do more kind of due diligence together in the research group. We also opened a new HAACU research group, so we can collaborate on HAACU in that research group separately. Before we open it up to Q&A, just one question. You threw a bunch of SPACs out there that you felt are high quality. I picked up on Luxa, the ZNTE, and the HAACU. If you had to pick one SPAC, which do you think offers the best risk reward at today's prices?
HAAC, certainly.
Okay. Okay, cool. So let's open it up to Q&A. We've already got a question here in the chat. In the meantime, before I read this one, go ahead and raise your hand if you can, so you can save your place in the queue here. It says, hi, Christopher. Thanks for the overview ideas. Question, historically, the SPACs have performed very poorly, except in 2020. There's almost a stain associated with them. What's the reason for them underperforming?
Because they're kind of a crappy vehicle, as they're most often done. I mean, of course, you have to compare it to an IPO. That's a hard question to answer. I think
alternatively, you can answer, why have they really picked up and done really well in 2020?
Partially because the volatility of the market has made IPOs more difficult. We've seen IPOs fail because of pricing reasons. Vagaries of just the venture capital market. A lot of firms that progressed further along in their lifespan using private equity and now are ready to go public. I think Chamath Palihapitiya, part of my pronunciation, has played a big role in popularizing them. It's a phenomenon that kind of has a life of its own. But there are advantages to SPACs versus IPOs. They're faster and easier, less registration, but they're certainly more expensive than a direct IPO. That's really the best answer I can give. What's the reason? They underperformed because they were poor combinations.
Very good. Next question from, I'm mispronouncing your name, Akalesh. Can you explain a bit about warrants and units? So a bit more about, you did touch on that.
Yeah, but, it's confusing.
Yeah, it was very helpful. You had a private call with me last week, and it was awesome in terms of units and how it breaks up into the common and warrants and the timing. Is it better to buy the units, better to wait? All that. If you don't mind giving that lesson that you gave me on the phone to everybody, that was so helpful.
Well, there can be opportunities at every stage in a SPAC's life, but if you can get into a unit early, like I traded Ajax. I bought it 3 weeks ago, about 3 days before it split. Its units were composed of 1 common share and 1 quarter warrant. And I bought the units for $11.50. After the split, the common shares traded just a little lower, 11.25, but the warrants traded up over $4 to $4.30, which allows you to dump those and essentially knock $1 off your cost basis. So if you can get units at a good price, there are a lot of advantages to them. Warrants, if you can snag them for under $2 or $1 for a SPAC that goes on to make an acquisition, you can do very well, but it's a little more of a lottery ticket. And I would advise against purchasing warrants priced over $4.
If I can just add to that, I think it's worth going over the mechanics again, because it's very unique and some people may have not caught it. So just giving HAACU as an example, after these IPO, they come out as units only. So, you know, if you put in HAA, right? So this one is still trading as units only. And then it's going to break off into 2 additional tickers. Chris, if I'm wrong anywhere, just stop me. It's going to break off into HAAC, which are the common shares, and HAACW, which are the warrants. And that happens roughly 52 or 2 months after the units start trading, the IPO. Is that right?
Yes, 52 days.
Okay. So we're I think pretty much in that period. There's, I think, a little bit of just a logistical delay, or we're waiting like basically any day. HAACU, it's already past 50 days, 52 days. So that'll split into these 2 additional tickers. Now, at that time, do the units always continue trading for all SPACs? So you have 3 tickers basically?
Yes, the units will continue trading, and they're worth watching because they present arbitration opportunities sometimes.
Got it. So if you say like the NAV is 10, a lot of people talk about a NAV 10. Is that mostly for the common shares, and that's why the units tend to trade a little bit higher because they also have the warrants built into it? Is that the idea?
Yeah, the units should trade higher because they have the warrants attached.
Right.
Still, like with ZNTE, I was able to buy the units just 30 cents above NAV, last week. So you can find opportunities. But I mean, this problem is you got to make sure you're buying something that has some legitimacy.
Do these also tend to surge on the day that they split? I'm just looking at ZNTE now, and I see these last 2 bars, and it looks like it just split. Is that a common occurrence?
There does tend to be a little bit of a surge at split. Excitement over the warrants is part of it, and then that translates into a higher unit price as it catches up to the warrants. Then it surges again on a rumor of combination or a letter of intent, and then it tends to surge one last time at combination.
Fascinating. So it looks like a lot of opportunities over here, just as a trading vehicle as well. Thank you, Chris. Let's go a couple more comments. Florian is mentioning the 20% founder shares also detract from NAV. For example, if there's a 1 billion in trust and everybody would redeem, the IPO buyers would only get 800 million. So everybody would only get $8 per share instead of $10. Is that any comments on that?
I'll look into that. If everyone, that might be the case. I'll have to verify it.
Did he say for HAACU though that the founder share is much lower than 20%, like the higher quality?
Yeah.
Okay.
Yeah. That wouldn't be at all relevant to HAAC.
Oh, so the higher quality ones don't even have that part at all?
HAAC is unique. The sales shares are unique to HAAC, and they are independent of common shares. They convert into them on a yearly basis based on stock price increase.
Okay, cool.
Chris, for HAAC, how long do they have to combine with another company?
2 years.
2 years?
Yeah.
And when did that timeline start?
Like
a few
little over
months
2
ago?
months ago. But
Okay.
I think because of the competition, they'll be forced to move quickly.
That's good.
incentivized to move quickly.
So maybe like 1 year or about there. Who knows?
There was a SPAC a couple weeks ago that announced the combination while it was still trading in units.
Okay. Yeah, that sounds good.
Yeah,
Yeah, with all the SPACs coming out, it sounds like it'll be a race to find the company and combine as fast as possible.
Exactly.
And I've been studying these for a little while, and they're really complicated, but you presented them in like a simple, straightforward manner. So thanks for doing that. If
Good.
you actually look into the math behind, it's very confusing. So
Yeah.
the way you presented it is definitely correct.
And each of them is different. I mean, it's amazing how different they are if you dig into their S1s.
Chris, can I ask you to just talk a little bit again about the mission for HAC and why you like that mission so much? I did hear you say you love the mission, but I didn't really catch the language.
It is actually the language of the S1. It's about a page and a half long. Let me see if I'll post it in the room, but it's a business statement. It's a creed of core. It's powerful. It's motivating, and that's a factor in venture capital and shopping combinations like this. I think just looking at the team and looking at their mission, I think these are the guys that are going to nail the best combination. The company that everybody wants to combine with, this SPAC has the structure, the team, and the language to make the combination.
Are they looking at any particular area of digital telehealth?
They've given themselves a very broad mandate.
Okay. Okay, cool. What else we got here? John Cison says you could also have sold the shares and had super cheap warrants worth $4 in your example. I don't know what example that was. Sell the shares and have super cheap warrants worth $4.
Yeah, but the warrants at $4 were overpriced, and they had eaten through most of their leverage. I mean, warrant agreements for SPACs would be a whole nother Sunday or two. It's complicated and deceptive. Honestly, I don't think many people that own warrants understand what they own.
And you know what? I've also noticed, I'm very new to trying to trade SPACs, and I've noticed that the warrants don't really correlate well throughout the day in an intraday trading session.
Mm-hmm.
You don't see that correlation there. I mean, the stock can be at high of day and the warrants at low of day, and then the stock's at low of day and the warrants at high of day. I mean, it's really weird.
Yeah.
So they're tough to trade.
Yeah, they're a little, they tend to get retail spurts, especially after hours. If you want to dump some warrants, hang around after 4 p.m.
Did you mention that the warrants have like no protection if the companies don't combine? The warrants lose all their value.
Yeah, nothing. 11.50 strike price. So they're done if there's no combination. But
there is higher potential reward for the warrants
to some degree, but like the cashless execution clauses really cap the leverage. And I mean, what do you do with a derivative that management dictates when it can be executed? What's the delta and gamma on that? How do you measure time risk? Pricing just gets really weird. And with the cashless exercise, it pins the warrant execution price to lower levels. It's complicated. Don't buy warrants.
It's actually a mix of people that own the warrants that have no idea what they own, and then other people that know that it should be worth less, so the price ends up being like somewhere in the middle of that.
Yeah, and nobody can short them. They're unshortable.
Oh, really? Is that so? Okay.
Yeah.
Interesting. Next question. I also look for the IPO sponsors from CNJ to have deep expertise in the target industry to be able to find right businesses and not overpay. Leaving the original
Definitely.
management on the helm is important as well.
I've decided, I've been looking for, you want people with deep industry experience, then like the finance guy. And I've decided venture capital is the way to go, not private equity. Venture capital has the right kind of skills for these combinations, and private equity is just more likely to be trying to liquidate their old investments, kind of the hot potato of private equity investing.
Ashley, I don't understand. You have a couple questions here. Do you mind jumping on mic and verbalizing your question? If someone can unmute them. My Zoom controls are frozen for some reason.
Is it not a profit split? I don't get that one.
Yeah, and he had another one I don't get.
Hey,
There you
I
go.
was just, I work in private equity and we have a 20% promote that's above, but it's like a profit split. So once everyone gets their money back, it's 20% like above that. So I was coming from that approach as to, at what point does the dilution occur? But it sort of makes sense if they want to get paid, the dilution, that 20% would occur at the closing of the transaction.
Yeah, that's my understanding.
Okay. That's all. Yeah. Okay.
So you're involved with one of these?
No, private equity, like apartments.
Oh, gotcha. Okay.
Suresh, what's your question about the tax aspect?
About the passive foreign investment vehicles. Just check if they're in the Cayman Islands or anywhere outside of the US, either close your investment in a SPAC within a year or keep your investment under 25,000 and verify what I just said with your accountant. Or you can get stuck paying interest on your share of the trust, as well as other tax penalties, which are in the accountant realm, but I know are punitive. So just watch out for Cayman Islands. If you must invest in a foreign incorporated SPAC, have a brief chat with your accountant. And
Great. Thank you. Florian threw up a link if anyone's interested about how the dilution works. I think we're going to wrap it up here. Well, if it happens before then, the permits get period goes, so whether they're closed. All right. So why don't we continue that conversation in the SPAC research group? Yeah, let's do it in the SPAC research group. Chris,
Good.
thank you so much for tonight's presentation. It was an awesome presentation.
Thanks,
Hopefully we'll all make some good money this year on these ideas. Thank you.